what does the Form 1040, what is Form 1040 all about, and what are you going to do? So first, what we do is, guys, first we take the entire income, whether or not earned, whether or not legal, illegal, whether it was, you just found it under the carpet, any amount of income in your possession during the tax year, you simply take it in your books and you call it gross income. So in GLIME, you have two sub-modules for gross income. There are a lot of things. We will do a lot of things, some in great depth, some in a way which is cursory. But the idea is you get a big gambit of everything which is to be taxed in the US. So remember, one key thing in this is you don't need to earn that income. There is no necessity to earn this income. Any income which comes in your possession during a particular year, that ideally, if you look at, so if the tax tells you that this is an exception, don't include it. Only then will you not include an income. Otherwise, any income. Now tell me, what are the various ways you can earn income? Quick. Guys, make it an interactive session. You will remember much. I'm telling you, you're going to have a lot of fun learning and you will remember and retain a lot of stuff. What are the various sources where you can earn income? Tell me quickly. How can you earn income? Right in the chat panel. There is a chat panel there. Just keep it open throughout the session. And when I ask you questions, you answer in the chat panel. Yeah. So what are the various sources of income? Fast. What? You don't know how to earn income? How do you earn income? I want you guys to start. Okay. Yes. Wages. Very good, Manali. Wages, salaries. Yes. What is the other source of income? Think. You're an earning. Both of you guys are earning, right? So when you earn income, it can be either that you're working is salaries and wages, or it could be that I have fixed deposits. Fixed deposits will give you interest income. I can have dividends from the stocks that I own. I can own a property. I can give it on rent and I can earn the rental income. I can write, yes. See, bonus is again part of salaries, Manali. Okay. Bonus is again a part of salaries. I'm talking about different sources of income, right? So I can have, let's say, I can have as you can work as an employee. As an employee, you can get wages or salaries, everything included, commission, bonus, variable pay, everything is included here. Then the other source can be, I can be investing. And I can invest where? I can invest in stock. I can invest in bonds. When I invest in stock, I get dividends. When I invest in bonds, I get interest. When I invest in FDs, I get interest. The third source can be that I am having a property. And when I have a property, that property can either give me a rental income or I can sell that property in a profit. And what I get is a capital gain. Yes or no, guys? So I bought a property at 100. After 3 years, I flipped it for 600. So that 500 becomes an extra gain for me. Now that is a gain that can be taxed by the US authorities. Okay. Anything else? I can be a writer. I can write a book. I think Harry Potter by J.K. Rowling. And when that book is written, every person, every time the book gets printed, I get a share of that bigger pie in the book, which is sold or printed, whatever the contract says. Okay. So you will see that there are various ways in which a person earns income. I can be a person working in a hotel and getting tip. Again, that will be related to my work. Or another factor can be somebody like me. I have my own business. I run my own professional firm. So let's say you guys become an EA and you set up your own practice. When you set up your own practice at that point of time, you will earn a professional income. Now that is going to be from your profits and gains from business or profession, isn't it? That can be another source of earning. Okay. So what do? There are so many places where I can earn income. You can be a farmer and you can be earning your income. That becomes your farm income, right? So what happens with various sources of income? All of these come and flow into gross income. But how do you report it? How do you report this? You report it various. So there is a structure. So what we're doing is, what is the structure that is given by the US in order to fit all of this into Form 1040. So we are trying to give you a broad structure where everything will flow into Form 1040. So what we've said, okay, if it is a dividend income or an interest income, I'm going to call it a portfolio income. So this is portfolio income. And where do you go? You say, okay, if you want to report portfolio income, please go to Schedule B. So imagine one form with a lot of annexures in it. The head form is Form 1040. And then there are various annexures, and these annexures are all connected to the main form. I will show you all of these annexures, okay? So one annexure is Schedule B that reports all your portfolio income. Then we have an annexure which is called Schedule E, which is for all the passive income. That means anything that I'm not actively engaged in, I am not working, but I am earning money. So I will have rental income. Then I will have something later when you talk about it. I can be a passive partner in a partnership. I can be a passive partner in a small company, which I term as a S Corp in the US. So all that passive income flows into Schedule E. So all rental income, all partnership income, all S Corp income will all flow together in Schedule E. Capital gains are shown in Schedule D. So Schedule D is for all the flipping over of the assets which have been sold at a profit or a loss. That gets reported in Schedule D. Royalty again is passive income. It goes to Schedule E. Profits and gains from business and profession is Schedule C. Your own small company goes to Schedule C. Farming income is Schedule F. Okay. So these are some bigger schedules. I know what you're thinking. Where is Schedule A? Schedule A is not for income. Schedule A is all for your personal expenses. So later on, I will show you where this schedule goes. Okay. So what are we doing? We are first bringing up everything and telling the tax authority, see, this is what I have earned in the entire year. Will everybody report farming income in Schedule F? The answer is yes. Will everybody report portfolio income in Schedule B? The answer is yes. Do you need to memorize the schedules? See, ideally right now you're just starting, so probably you will have to commit it to memory. But once you start seeing the schedule so many times and working with it, then it becomes a part of you. You will not have to put an effort to memorize it. But yes, this has to be remembered. Okay, everybody clear? So the first part that we're going to do in modules 2 and 3 is we are going to talk about the gross income. What gets included, what gets excluded, where are you going to report it, under what basis? So typically you will see that when we read the modules, we are going to classify it under 3 heads. We're going to classify it into dollar, which is included in gross income. We're going to talk about dollar, which is excluded from gross income. So what is the amount of money that you don't have to pay tax on? So I'll give you a small example now. Let's say somebody has taken an insurance policy, okay? And that person pays premium for 5 years. In the 6th year, unfortunately, that person meets with an accident. Then there's a big amount of sum assured that flows to his beneficiary or the person whose name has been written as a nominee. That money, when it flows to that nominee, will be excluded from income. That means that person will not pay tax on that income, which is the terminal amount that is received of the sum assured because of a policy that has been taken. So who says that you will not pay tax on it? The IRS. Where does it say it? In provisions that talks about gross income. Is this clear? Then we'll talk about a lot of sources of income which are partly taxable and partly excluded. Is that clear? So you will see how some amount of income is taxable always, how some amount of income is excluded always, and how some amount of income is partly excluded and partly taxed. So the first 2 modules is only, so subunit 2 and subunit 3, we are only going to talk about the gross income. Oh, is this clear? Anybody, any questions? Ashwin, I want you to open up. You know, when you're in my session, try to make the most of these classes, answer all the questions. So you don't bother about how silly the question is. It's important that you're applying your brain and we're learning. Okay, so make the most of these classes, go back home, get into an auto mode. Don't think, you know, that time that you will sharpen your pencil and you will work on a desk, and that ideal time will never come in your life, guys. Okay, now you have to study with your work. Okay, so gear up. So that is the first thing. Now, can I wrap all of this, guys? Then I will go to the next step. Is this clear?
Yes.
Then what will Then then what will come? So what did we say? We said, okay, let's bring everything into the picture. What is coming into the picture? We are getting gross income. Okay, what I'll do is let's just keep it like this. I'll just change the okay. So what we did? So we started with gross income. So after gross income, what we did? So first we bring everything into the kitty and we call it gross income. And here we have so many master schedules that we already spoke about. After this, there will be first layer of deductions that the government will give you. So imagine a big tank and that tank is now full. You've bought everything and offered it to IRS. After that, IRS gives you taps. It said, okay, this is tap one. If, and there is a sieve here, okay, and we say, okay, only if this income qualifies the benefits of this sieve, can you leave this income and the rest can flow out. That means you don't have to pay tax on that income. It's like saying, I ask you to put everything, then I tell you, okay, do you qualify for this? If yes, okay, take this out, don't pay tax on it. So this is actually on what you pay tax. Is this clear? This is the amount on which you're going to pay tax. So everything that ideally legally comes out is the amount on which you don't have to pay tax. So we call this a deductible amount. Anything that helps you reduce your taxes is a deductible amount or non-taxable. The words that we use it in tax is either it is non-taxable or it is excluded or it is deductible. Okay. So for that, the first layer of deductions are called the adjustments. Okay. So what has the IRS done? IRS has given you a huge list, and IRS says that if you are in any of these lists, so I've given you a big list, and let's say there's a 11 or a 14 item list here. And I've told you exactly under what condition can you take a particular item out, what is the amount that I give you as an adjustment, that adjustment comes out. If that happens, then I let you take only till the amount that these guys tell you, only that amount will be allowed to come out. I'll give you an example. IRS specifically says if you are, if, okay, I'm thinking of something easier. Educated. Okay, let me think of something very simple. If you are a student pursuing higher education and if you get a loan, some part of that interest in that loan is not included in your income. So that part of interest on loan that you pay, which is not going to be taxed, that will be a part of adjustment. Another example is an educator expense. So if there is, let's say, a teacher who's teaching till class 12, okay, and she's going to spend some amount of money in preparing for her classes. Till certain extent, I have allowed him or her to exclude that as an expense. So all of those will become valid reasons for you to not pay tax to the IRS. That's called adjustments. Okay. So I have given you 14, 15, 13, whatever the numbers are on the list. Okay, if I have items 1, item 2, item 3, item 4, so I have educator expenses, I have student loan expense, I have, let's say if I tell you, you save for your retirement, some part of it, so I call it IRA deduction. We'll read it when we go there. So it typically means that I put some money in my retirement benefit fund. So the money that I'm putting in will not be taxed. Okay. So I have a huge list. Okay. Now, does any one item depend on the other? The answer is no. I give you a list, I give you the limits. If you have any amount which is in that limit, you will get that as an adjustment. Also, there is this concept of withdrawal. I call it, something like if you are really super rich rules, right? We have progressive taxation rules. What do you mean by that? I give you a deduction. In India, we have this subsidy. Are you aware? This LPG subsidy, that subsidy. What was the LPG subsidy? Any guys? Any of you, do you know? These cylinders that are given to your home, they are subsidized. And the government has asked you to fill up a form saying that if your income is more than 10 lakhs as a family, then you give up that subsidy. Why? Because we say that you're earning so much that you don't need that LPG subsidy. So if you fill up that form, you don't get the LPG subsidy. It's the same thing. If you're really rich, and I've defined what that rich means, if you're really rich, then you don't have to get this deduction, because I don't think then you're in need of these deductions. So everywhere, in every provision that we do, there are certain cases where they will have the instances of progressive taxation, which means I have given you some benefits, but as your income level will increase, I will roll back that benefit. Okay, so you get a 5,000 deduction, but the moment your salary becomes greater than this figure, I will keep on reducing this 5,000 from 5,000, 4,000, 3,000, 2,000, 1,000, and then the buzzer will beep, and I'll say, now you are really rich. Now you don't have to get this deduction. So next chapter. So what I'll do is first I'll give you the overview. Then I will link it to all the chapters in your units. Okay, so you get an idea of what chapter is dealing with what. Okay, so here we'll do a whole list. Remember, all of these are independent items which are not dependent on one another. If you have even one of those deductions, two of those deductions, or all 13, 14 of those deductions, you can get all of them. And that's why it is called proper tax planning. Is this clear? Is the second thing clear? So you have gross income, then you get the first level of deductions. We call these above the line deductions. Okay, so remember, these adjustments are any one of these items on the list, any time, any amount, or any time of the year. And these are also termed as above the line deductions. Is this clear? These are termed as above the line deductions. Now, why are we calling it above the line deduction? Why is this line so important? Because what you're getting out of this figure is called AGI, adjusted gross income. Okay. Now, why is adjusted gross income very important? So what did we say? We said, okay, you start with gross income. After the gross income, you get the first layer of deductions. We call it adjustments. And after the adjustments, what you get is called the adjusted gross income. Why is the AGI very important? Because ideally, this is the yardstick in which you categorize the society. What do you mean by that? I'll tell you. This is a very important yardstick by which you define, okay, by which you define what? You define whether you are rich, whether somebody is super rich, whether somebody is poor. All of this is defined. These are not terminologies that tax uses. These are terminologies that I am using. Why? Because once you have the AGI, then you put that entire society in that bracket, and I say, if your AGI is beyond this threshold, you will not get this deduction. If your AGI is beyond this threshold, I will reduce your deduction. So what is that yardstick? That yardstick is the AGI. That is why this line that arrives at the AGI is very, very important. And we define the deductions as above this line and below this line. So above the line adjustments above the line deductions are termed as adjustments. There's a big list, any amount, any time, any figure, any head. If you are there, you get that deduction. Is this clear till now, guys? Is it clear till now? Okay. Now, after this, now you have a choice. What choice you have? Now I tell you, there are two more deductions that are applicable. The first deduction is called the standard deduction. This is the portion that we left out in module 1, if you guys remember. What is standard deduction? Now see, what happened was Tax Cut and Jobs Act came when Donald Trump came into power. I have told that to you before, right? So what happened? This guy removed the dependency exemption. So what was happening earlier? We took the number of heads who are dependent on us. We took a big figure and then we multiplied it by the number of heads. And we would say that this is the amount of deduction we are going to get. So that meant that in the US, I'm giving you an economic incentive of having more and more people dependent on you. So Donald Trump did away with that. He said, forget about it. What I will do is I will increase your basic standard deduction. So you can take a basic standard deduction, which is one figure, which gets indexed every year, somewhere around 12,000, 12,500 this year. I don't know what it is. We'll just check up. Okay. Or what you can do is you can also take a second deduction, which may be called an itemized deduction. That means obviously we'll need the higher of the, isn't it? Whichever gives me, because this is what, again, this is another, this is a level 2 leakage. Can you understand? This is step 2. So what do you do? The first step is adjustment. I tell you, if you have any of these, take it out. The second tab now becomes either a blanket figure, one figure that I give you, or I give you another figure, but this is not independent. This is a big Dhobi list that I've defined for you. And you put all the items in this list together. And then, so basically in your mind, this is how you should visualize this. In your mind, it should be like this. There is a weighing scale. At one end of the weighing scale, I have the standard deduction. So at one end of the weighing scale, I have put a big bowl, and that bowl is only having the standard deduction. And on the other end of the weighing scale, I have put a big bowl, and that big bowl has all the items of itemized deductions in it. So again, there will be some 12, 13 items. I have put all, and I've called it itemized deductions. Now I'm going to compare your standard deduction with your itemized deduction. If your standard deduction, if your standard, so if the balance is like this, right, that your standard deduction is higher than your itemized deduction, then what I will do? I will scrap the itemized deduction and I will take the standard deduction. And if the balance tilts in the favor of itemized deduction, where if I put all of the itemized deduction together and I compare it with standard deduction, and the itemized deduction is greater than my standard deduction, I will scrap the itemized standard deduction and I will take the itemized deduction. So we take a greater of the two figures. We take the greater of either the standard deduction or the itemized deduction. But please remember, guys, itemized deduction is not like adjustment. Adjustment was individual. Itemized deduction is like team. You put them all together, and then that team will be running against the standard deduction. So imagine it's like, I don't know if I have very weird imagination sometimes, and I'm giving you some examples like this. Imagine there's a big fish, let's call it a whale. Okay, so this is your standard deduction. And then imagine a lot of small fishes, which will all come together and be a big fish. This is your itemized deduction. Do you understand what I'm saying? So all of these small fishes coming together, and then they are fighting with the whale. If the whale wins, you take the whale. If the smaller fishes win, then you take the smaller fishes. But if I segregate each individual fish, will it have any relevance? The answer is no. That is not the case with adjustment. Adjustments, an individual fish matters. In itemized deduction, the individual has no meaning. All coming together will make a bigger fish who can compete with the standard deduction. Is this clear? Is this clear, everybody? Okay. So what we said? We said, okay, we first start with gross income. Then from the gross income, we deduct the first layer of adjustments and we call it above the line deductions or adjustments. Now, after that, what you get is a very important yardstick. I call it adjusted gross income. Why is it important? Because the more I increase the adjusted gross income, I go to a category, which is the super rich category. And that clearly says that my benefits will start getting withdrawn. Because now I'm really becoming rich, so my benefits will start coming down. So imagine a guy running. The moment he crosses a particular yardstick, again, see, I have vivid imagination, but somehow it helps me, understand things and also communicate things very well. So imagine a guy who's really poor. Okay. And we tell him so this guy is running. The moment he runs and he crosses a particular hurdle, I start dressing him up. So immediately he gets into his tees and he gets into shorts, and then he goes later and he starts becoming a bigger person. He starts wearing coat. And after some time, the moment he gets into a stage when he gets a Rolex watch, I say, boss, now you don't need to run anymore. You've crossed the line. That is the case with AGI. Every yardstick you cross, I start defining you as richer and richer and richer. And it's like saying, if you are somebody who's a small fry, I give you a bundle to support. And every time you become a bigger fish, that bundle gets reduced. Get bundle gets reduced. And somewhere when you really cross the barrier, you have no bundle. So it's like saying the state is helping you, and every time you go ahead, you start needing less of that state's help. You get further ahead, you start needing less of that state's help. And the moment you go ahead beyond a particular level, you say, boss, now you're independent, now you don't need our support at all, so we withdraw all the support. Is that clear? So that is the AGI, and we will see how this withdrawal function works also. Okay. After the AGI, it said what? Now you have below the line adjustments. Now, what are these below the line deductions? I suppose this is not individual. At one end, I have that big whale, and I call it standard deduction. And on the other end, I have all of these, so I call it a big whale. Let's call it a big whale here. And I call it a standard deduction. And now I have a lot of these small, small fishes who are going to become a bigger fish only by virtue of coming together. And this I call as itemized. Okay, let me just write it for you. And this I'm going to call it as itemized deduction. And we are going to say which one is bigger, and whichever is bigger, we are going to take that and we're going to leave the other one. Is this clear? Now, this is the second. So if I look at it, this is step 1. What was step 1? It's the first leakage that helps you take some amount of income out and not pay tax to the government. And we also called it above the line deductions. Now that line of AGI has been drawn. We have already put you in a ladder. You are rich, you're super rich, you need deduction, you don't need deduction. Then I go to tab 2. What is tab 2? So I had a big figure and I called it, I had a big figure and I called it all the income has come in. Now I opened another one tab for you and I called it tab 1 and I called it adjustment. The moment tab 1 came out, what you get is a definition of how rich, poor you are. Then, so you get this visual. Then what happens? Then I have the next visual. So this was above the line and this was below the line. I call it tab 2. Tab 2 is I find out which is more. Standard deduction, itemized deduction. Whichever is more, I take that and I scrap the other one. Then I have a third deduction, and that third deduction is called the QBI deduction. What is QBI deduction? The QBI deduction is termed as qualified business income deduction. Just give me one moment, guys. Yeah. So now what is a qualified business income deduction? What was the need for this deduction? Now see what happened, understand this. What happened was US reduced its corporate tax rates. Okay. Now what happened? The corporate tax rates were somewhere around 30, 35, and now they brought it down to 21%. Now, when I say you reduce the corporate tax rate, now Manali would know it better because she's done part 2 with us. See, corporate means you are a C Corp. If you are a C Corp, then you have your independent taxation. That means you are a separate legal entity. You file a separate form and you pay tax on it separately. So what happened? All of these bigger companies in the US, they got to reduce their taxes phenomenally. Okay, the taxes got reduced. Now all of these smaller companies started fidgeting. They said that I am a S Corp. So later on, when you do part 2, you will realize how C Corp pays a different taxation, but an S Corp partnership like 1120S, 1065, these are forms which are flow through entities. That means, let's say there is a partner 1, partner 2, partner 3, and we have a partnership. Okay. Or we call them member 1, member 2, member 3, and we have a S Corp, a small corporation in the US, which is like a private limited company in India, right? What will happen? There will be a form 1065 for partnership, and there will be a form 1120S for S Corps. But this will only be for information purposes. Okay, this will only be for information purpose. That means I will first calculate how much money was generated in the business. And then each of these people, I will distribute that money. So let's say $300 was made by the company. Each of them will include $100 in their return, and they will pay taxes in Form 1040. Do you realize what I'm saying? That it is not the partnership which is paying tax. It is not the S corp which is paying tax. It is these individual members who pay tax on the income that they're earning through the partnership or the S corps. Okay, but that is not the case with the C corp. Why? Because in C corp you have the company who is paying the taxes. It is not the individuals who pay the taxes. So what happened? Now, see, C Corp got a big deduction. The taxes came down. So, all of these S Corps, partnership, they started fidgeting. Sole proprietorship, which you report in Schedule C. Okay, so it's three forms of businesses. Understand? So, what are the three forms of businesses? You have partnership, you have S Corps, you have sole proprietorships. So, basically, if you look at in the US, we call them flow through business entities. Okay, so we call them flow through business entities. What are flow through business entities? These are entities which just calculate the taxes, but they don't pay taxes. They just calculate the profits. The profits flow through from their return to the individual members or partners. They are the people who pay tax on that income. So, what are these? These are sole proprietorships. These are partnerships. And these are S corporations. So these companies still had very high tax rate. Why? Because the individual tax rate was 37%, which was the highest tax rate. So these guys started complaining. You have given benefit to the C corps. What about us? We are paying tax at the rate of 37% marginal tax rate. So what the government did, they came up with another deduction only for these flow through business entities, and it was called qualified business income deduction, which essentially means that if you're having a qualified business that is being organized as a flow through business entity, then there are some rules, but around 20% of that amount you can escape from the tax net. Now, this is out of the syllabus. We are not going to discuss a lot in this. They have given it to you, but there's not a single question that is asked in this. We're going to keep it very, very simple for you. Otherwise, this is really complicated. Okay, so this is typically your tab 3. 1 second, guys. Okay. Is this clear, guys? Everybody? So there is this form. We'll tell you what the form number is later. And what you get out of all of this is called taxable income. This is the income on which you have to calculate your taxes. Is this clear? Anybody, any questions? Is this clear? Anybody, any questions? So see what we said? We said first put everything into the bucket and give it to the government. Then the government tells you, are you having any of these adjustments that you can claim deduction for? Then you take it out from that bucket. After that, what you get is a very important yardstick called the adjusted gross income. From the adjusted gross income, you either take the standard deduction or you take the itemized deduction, whichever is greater. Whichever is greater. Then you have the third deduction called the qualified business income deduction. After that, what you get is your civil income. Is this clear? Now what you do, now you start calculating taxes. So how do you calculate taxes? You apply your slab rate. Just like in India, we have a slab rate structure, isn't it, guys? In India, we have a slab rate, isn't it? Till a particular level, no amount. After this, in a 10 to 20, this is the bracket on which you're going to pay 10%, then 20%, and then 30%, right? Similarly, in the US, there's a slab rate structure. You're going to apply that slab rate and you're going to calculate your taxes. Okay, so let's say we calculate our federal income. Now, understand that what we've done is we have ensured that you get either a regular tax or something called alternate minimum tax. Now, this is a very interesting concept. In India, we have it for the corporates also. But in the US, they have withdrawn it from the corporates. Now it's only the individuals who need to pay a minimum amount of tax each year, which is called the alternate minimum tax. So if after you've calculated your taxes, you realize that it is even lower than your alternate minimum tax, in that case, we ask you to pay an additional amount and we call it, you have to reach till alternate minimum tax. And later on, you will see that how with the alternate minimum tax, next year you can level out your income. So the idea is not to increase your tax outflow. The idea is to stabilize your tax outflow. So we are going to read about this later when we get to this, right? So first you calculate the federal minimum tax and see it is actually equal to your AMT. If it is equal, forget it. If it is higher, forget it. If it is lower, then bring it to AMT and then pay the AMT. Okay. Then what you do, you add some other taxes. Okay. So typically these are somewhere in the nature of penalties. Okay, you've done something. So say something called, okay, let's just give you one or two examples here. You're going to read about it later. Let's say we have something called self-employment tax. So I am employed. Like today, I'm a self-employed individual. So I have to pay a tax called the self-employment tax. Then there's something called the social security tax. All of these are some extra taxes that are outside the ones that we've calculated. So now you calculate and put it extra. So what we did, we calculated the taxable income. Then we applied the slab rates. We found out the federal income tax. We compared it with the AMT and we have to pay minimum AMT. Then we have the other taxes. After that, there are some things called credits. Okay. It's like saying that these are the reasons. It's like, gift voucher. If now you have a gift voucher or a coupon that can reduce your taxes, you can reduce it. Okay. And if you have, let's say, any kind of a tax deducted at source, somebody has already deducted some of your taxes earlier, then that is also going to be reduced now. And then the balance of all of this is going to give you either tax due or tax refund. Is this clear? Everybody. So we start with gross income. We get the first layer of deduction called above the line deductions. We get the AGI. We reduce the standard or the itemized deduction, whichever is higher. Then also we reduce the QBI deduction. What you get is a taxable income. Apply the tax slabs. Understand what is your AMT. Pay at least the AMT. And then you add the other taxes, maybe self-employment, social security. From there, I reduce. So can you see this is actually another layer of benefit that I get you. And after that, you just see if there's any other withholdings. So in the US, we don't call them tax deducted at source. We say taxes withheld. Withheld taxes. You reduce all of that, what you get is tax due or tax refund. Now there's a chocolate question. Let's see who answers this. Please answer in the chat panel. If I tell you that an item can be given as a credit or a deduction, Which one will you prefer and why? I have, let's say, $100. Okay. And I tell you, you can either claim it as a credit or you can claim it as a deduction. Tell me, which one would you prefer and why? Yes, guys? Which one will you prefer and why? Would you prefer a deduction? Would you prefer a credit? Or are you indifferent to both? Both will give you the same tax benefit. What do you think? I want some answers, guys. Okay, if because if you don't, if you really make it a completely a class which has a deduction, Anali says a deduction. Ashwin, what do you think? Would you prefer a deduction? Would you prefer? But why? Why do you think a deduction is better than a credit? Why? Anali, unmute. Take the question. Why do you think a deduction is better than a credit? Quick, quick, quick. Why do you think it is better? See, if my tax rate is, let's say, 30% on an average, if I give 100 as a deduction to you, you will be getting only $30 as a benefit, isn't it? Because I will say, on the taxable income, I will calculate the tax slab rate. So basically, I've got a benefit of only $30. But a credit is given to you after the taxes have been calculated. So if I give you $100 credit, I will reduce the entire income tax by $100, isn't it? See, if let's say my total income tax was $2,000 and one of the items here had a deduction. So if I take $100 as a deduction, I will reduce only $30 from the tax. But if I take something as a credit, I can reduce $100 completely because a credit does not have a further tax applied to it. So it is always better to have a credit than have a deduction because a credit is a dollar to dollar deduction. A credit is a dollar to dollar deduction. Have you understood this? A credit is better than a deduction. Why? Because a deduction is something that is before you calculate your taxes. So you have to have a tax rate applied on the deduction. But that is not the case with a credit. So I will always prefer a credit over a deduction because with credit, I get a dollar to dollar deduction of taxes. If I have a $2,000 credit, I can save $2,000 tax provided I have a tax base large enough to absorb the credit. Is this clear? Everybody, is this clear? Okay. Now let's just see your form. Then you get a visual of where I'm going to get this for you. See this. So see what we did? We started with 1040. There was a filing status. This is all your details. Remember, we spoke about social security number, your spouse's social security number, ideally because they file a joint return. And if you get a social security number, that means you're either a resident alien or you're an American citizen. Okay. Then you have disclosures about some digital assets. We're going to talk about it later. Then we have the standard deduction. Again, we're going to talk about this later. Okay. Then we had the dependents, which we've already spoken about. Now, can you see the first area here is the income, where you start from wages. Then we have the tip income, the employment wages, the Medicaid waiver. Then you have some taxable dependent care benefits. Then you have some employer provided adoption benefits. So these are all related to your work, wages, other earned income. Okay. So all of this will be typically your earned income. You start from here to here. This typically is your earned income by way of you working somewhere and earning that income. Okay. Then we have this tax exempt interest. And can you see where it comes from? It comes from Schedule B. Then we have the dividends, again, which is coming from Schedule B. Then you have some distributions from IRAs, pensions, annuities, social security benefits, which is all given on the face of the income of the Form 1040. Now, apart from that, we have the capital gains, which, as I told you, will come from Schedule D. Can you see this? This is coming from Schedule D. Then we have some other income, which will come from Schedule 1. From here, you get your total income. Then you get your adjustments. Okay. And after the adjustments, can you see again the adjustments is coming from Schedule 1. So there are three major schedules, Schedule 1, 2, 3, and then you have the numbers, Schedule A, B, C, D, E, F, and K. These are the major ones. Okay. So what you do, you get from adjustments and other income. So if you look at this, one second. Okay. So, you should do it like this. So I have three major schedules, Schedule 1, Schedule 2, Schedule 3. And then you have Schedule A, B, C, D, E, F, K. Okay. So Schedule 1 will have other income, and at the same time, it will have adjustments. Now we know this. Schedule B is coming with your portfolio income. Sorry. Schedule B is coming with your portfolio income. Schedule C is your own company. Okay, so basically it's your business income. Schedule D is your capital gains. Schedule E is your rental income, or basically all your passive income. Let's call it passive income. Schedule F is your farming income. Schedule K is actually an adjustment that goes to Schedule E. So the income that you get from partnership, S Corp, all of these income will be an attachment to your Schedule E. And then from here, it goes to Form 1040. Okay. Schedule A is actually your itemized deductions. You remember itemized deductions or standard deductions, whichever is higher, that will be Schedule A. Okay. I will show you these schedules also, don't worry. So you remember? Now, qualified business income deduction is Form 8995. Now, you need to know this, by the way, okay? So these are some bigger ones that I want you to remember. Form 8995 is your qualified business income deduction. Keep that in your mind, okay? Then what you get is a taxable income. So you see, we've added all the income, we've reduced the adjustments. Now from the adjustments, we reduced either the standard or the itemized deduction. Itemized deduction is coming from Schedule A. And then what you get is your qualified business income deduction. And the final thing will be your taxable income. And here, what are the schedules we've taken? We've taken Schedule 1, which has other income and it has your adjustments. Then we have taken Schedule A, which is your itemized deduction. Schedule B, which is portfolio. Schedule C, I don't see here. Where is it? Yeah, we'll see how Schedule C is flowing. Then we have Schedule E. Okay, now see. Then comes your tax and credits. Okay, so that is Schedule 2. All your other taxes and credits will go to Schedule 2, right? So when we go here, this is Schedule 2. Sorry. So these are your taxes and credits. So all the other taxes and credits that will be reported in Schedule 2. Okay. And then we have all of these payments, which are your withdrawals, right? So all your TDS, as you call them, all your TDS, earned income credits, all of this will come here. Okay. Yeah. All of these total payments, refundable credits, everything will come here. And then is your final thing, which will be your tax due or your tax refund.